Why it's okay to put more than 20% down is you can still achieve a worthwhile return. What most people do is run their numbers on a rental property with 20% down, and if it doesn't cash flow at 20%, then they think it's not a good enough return and will just move on to the next. Now, the reason investors stick to this 20% down payment when running numbers is because of leverage. The less you put down, the greater your return will be because you're controlling the full asset with less money. And most lenders require you to put at least 20% down when buying an investment property. For example, when you're able to put 20% down, all the property's appreciation return is multiplied by 5. So if the property goes up in value 3%, you get a 15% return on your investment from appreciation alone. If you put 25% down, it's multiplied by 4, giving you a 12% return. 33.3% will give you a 3x or 9% return, and 50% down will give you a 2x or 6% return. It's a similar effect with the other ways real estate delivers a return. The couple $100s a month you get in cash flow is a better cash on cash return if you put less down. Principal paydown adds up more each month with a bigger loan, and the percentage return is higher when you invest less money up front. And lastly, the tax benefits from depreciation are based on the building's value regardless of how much you put down. So once again, putting less down gives you a higher percentage return relative to your investment. That's why most investors don't think about adjusting their down payment. Lenders require a minimum of 20%, and the less you put down, the better your returns are, so why would you ever do more? Well, the reason is simple. None of those returns matter if you can't hold onto the property long term. And the key to holding it is healthy cash flow. This is where a lot of investors get stuck. Someone might think if I put 20% down, I'll get a 30% ROI, and if I put 35% down, I'll only get a 15% ROI. Then when they run their numbers at 20% down, they realize nothing will cash flow enough for them to hold it long term, so they just don't buy anything. But the reality is you can still buy with 35% down and get a lower percentage return relative to 20%, but you're still achieving the best possible returns in today's market. Because I certainly wouldn't count on the stock market giving a consistent 15% ROI. So if you have money to invest, it's something to think about, because I know you'll get better returns than if that money was just sitting in the bank. And if you truly can get better returns investing elsewhere, obviously do that. But the bottom line is it's always going to be better to put less down if you can make it cash flow. But if nothing is working at 20%, putting more down can still give you worthwhile returns. And then in the future, if rates go down or rents increase, you can refinance back to 20% equity. At that point, you'll maximize your leverage on returns. And then in the meantime, before you refinance, you'll be earning a nice return and be ready to refinance as soon as the opportunity comes.